Yeah, thanks, Neerav. Good day, everyone. On behalf of Prabhudas Leeladhar, I welcome you all to the 1Q FY24 earnings call of H-Chan Limited. We have with us the management represented by Mr. Saurabh Mittal, CFO, and Mr. Atul Soni, who heads the Investor Relations Department. Due to some unforeseen circumstances, Mr. Himanshu Gupta is not there on the call today. I would now like to hand over the mic to the management for opening remarks, and after that we can open the floor. Thank you, and over to you, sir.
Thank you, Dinesh. Good afternoon, everyone, and thank you for your time. I am Saurabh Mittal, CFO at H-Chan. I would like to welcome all of you for the first quarter results conference call for FY24, and thank you all for taking out the time and joining us here today. I'm extremely happy to share that Q1 FY24 has been an exceptional quarter for H-Chan. We've hit the following landmarks during the quarter. H-Chan Group has turned net debt free with quarter-ending net cash balance of 546 million. We've had the best working capital metrics for receivables and net working capital in Q1 in the company's history. Highest ever Q1 sales, highest ever Q1 gross margins, highest ever Q1 EBITDA. On the cash flow front, we have maintained strong operating cash flows versus last year. As we have now firmly entered FY24, we see that schools and colleges are back to their pre-COVID schedules with regard to admissions, school openings, examinations, etc. This has reduced the uncertainty in business, which has improved the cash flow cycles of the schools, channel partners, and distributors. This is reflected in the improved realization from the channel during Q4 FY23 and Q1 FY24. On the National Curriculum Framework or NCF front, we saw the launch of NCF covering the foundation stage, classes kindergarten to class 2, last year in October 22. We look forward to more such announcements for the other classes coming through over the next couple of months. The NCF opens up a large opportunity to provide engaging and innovative content to students, teachers, and schools to make the learning more experiential. The NCF focuses on activity-based learning and provides for flexibility to students to choose between subjects. This will help the company gain market share with its brand and strong product portfolio. We expect to launch over 500 new SKUs in the school segment this year. On the higher education front, the last 3 years, the academic cycle in various universities was disrupted during COVID exam result delays, with semesters starting as late as November. This year, we have seen board results being announced as per pre-COVID timelines, and CUET, JEE, and NEET exams also are completed on time. This ensures that the new semester would begin in July-August, and normal academic year would return from this year onwards. The NEP has been implemented in a few states where we are seeing strong traction for our products, which are based on the NEP. On the EdTech investment front, we have invested rupees 30 million for a 4.3% minority stake in iXambi in April 23. We believe iXambi is well suited to benefit from the rise in the competition segment in the future by helping graduates and undergraduates prepare effectively for government examinations like banks, insurance companies, railways, etc. H-Chan is already partnering iXambi and other GPUs for examination-oriented products. Our other investments, Smartivity Labs, saw strong results as well. On the EdTech front, H-Chan Academy continues to have phenomenal success. We have now launched over 1,400 videos focused on higher education topics covering science, engineering, and test preparation so far, and the channel has already notched up 15 million views and approximately 170,000 subscribers. This further enables the promotion of our content, further spurring demand in segments with blended offering. This channel enables students to learn critical areas through top-notch educationists, which may not be available in Tier 2 and Tier 3 colleges. We expect to add another 600 videos for both the school and college segment this year. Test Coach, our test prep app, is seeing strong traction with to cover over 50 plus government vacancy tests, which is a huge market. We are adding features apart from mock tests. There will be concept videos, doubt clearing sessions, etc. We expect increase in government vacancies now that things are normalized post-COVID and with elections due in 2024, which will further spur demand. Smart K, our preschool curriculum, which is activity-based, is mapped to the NCF, continues to gain traction across schools in India. Milestone, our K8 curriculum solutions also continue to provide holistic learning to schools both in India and Middle East. Now coming to the numbers for the quarter, our consolidated operating revenues came at 1,111 million versus 1,073 million during the same time last year. We improved our gross margins to 69% versus 67% in spite of the sharp increase in paper prices, as we did better planning of print batches and reduced wastage. This is the highest Q1 revenue and gross margin in the company's history. We reported EBITDA profits of 136 million versus 119 million in the corresponding period last year, which is the highest Q1 EBITDA in the company's history. Happy to share that this quarter we continued with PAT profitability in Q1 with profits of 11 million versus 62 million in the same period last year. Lower profitability is driven by other income, which had a one-time gain on account of fair valuation of our investment in Smartivity of 105 million in the same period last year. I would like to bring your attention to slide number 6 to slide number 9, which showcases the result of steps taken during the past 3 years.
Sir, we lost your audio when you were going to the slide discussion. Can I request you to come a little closer towards the phone?
Okay. Yeah. I would like to bring your attention to slide number 6 to slide number 9, which showcases the results of the steps taken during the past 3 years towards building a cost-effective and lower working capital organization with focus on positive cash flows. Trade receivables reduced to 1732 million during Q1 FY24 versus 2109 during Q1 FY23. This is a 377 million decrease in receivables year on year. In terms of receivable days, it stood at 103 days versus 139 days, a reduction of 36 days over the previous period. This is the lowest Q1 receivables in the company's history. Inventories increased slightly to 1436 million versus 1352 million on the back of higher level of raw material inventory. This increase in inventory is due to the unprecedented hike in paper during the year. The inventory level includes the raw material paper inventory of 371 million versus 301 million last year. In terms of inventory days, we improved our over last year at 193 days versus 202 days, a reduction of 9 days during FY23. Net working capital reduced to 143 days versus 162 days, which is a reduction of 90 days over the previous year. This is the lowest net working capital days in Q1 in the company's history. In terms of debt, we ended the quarter with net cash balance of 546 million versus a net debt of 279 million in the previous year first quarter, and gross debt of 1,906 million versus 1,145 million. In terms of cash flows, our strategy of focusing on cash flows has yielded results, where we ended the quarter with OCF of 691 million in the current quarter versus 633 million in the same time last year. As we continue into FY24, I would like to reiterate for this year. Firstly, we are looking to do annual revenues between 7,200 million and 7,500 million, which translates into 18 to 22% growth for the year. Secondly, we would be taking a single-digit price hike across our product portfolio. Thirdly, gross margins can increase in case paper prices stabilize or decline during the year. Fourthly, we are targeting EBITDA margins of 16 to 18%. Fifth, we will look forward to the announcement of the NCF for more classes in the calendar year 23, which will help in volume expansion. This should lead to strong volume, revenue, and profitability growth for the next 2-3 year period. With this, I would like to open the call for questions. Thank you.
Thank you very much. We'll now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. First question is from the line of Nitin Dharmawat from Aurum Capital. Please go ahead.
Yeah, thank you for the opportunity. I just wanted to know how is the trend of paper prices now, if you can throw some light based on the current price movements, especially the printing paper that we are using. And second is about how much inventory we are maintaining. Have we compiled the entire inventory, or are we going to build the inventory in case the prices are moving up again?
Yeah, thank you, Nitin. So paper prices are down about 8 to 10% from what we bought last year. So average at this point of time. And just to reiterate that we have already contracted almost 60% of our supplies for import from Indonesia. So the price are fixed for that period, and that supplies will be from between September to December. In terms of holding inventory, of course, we cannot hold a long period inventory. Maximum inventory we hold is about 45 to 60 days. So that requires a lot of space. So we will stagger the supplies, and we don't see a challenge as of now this year in terms of building inventories as and when we require. We're not holding too much of inventory, but we've already placed orders for both for imports and for the domestic market for our requirement up to October already.
Oh, got it. My next question is about the impact of the NCF which is coming up. So we had given some revenue projection numbers. So do we maintain the same, or are we having any change on it?
No, we are maintaining our number, and in fact, as and when the NCF comes this year, that will only further spur demand. Having said that, we are well prepared in terms of the content is ready, because the draft NCF is already available, and largely it's around the NEP and the NCF. So what is already known, the work is already in progress for that. And once the NCF is announced, our products will be out in the market shortly after that.
Got it. Final question is about how is the current quarter going on? Since this quarter, generally the second and third quarter especially are not very strong in terms of revenue for our kind of business. A lot of seasonality built towards the end of the year. But this year I wanted to understand, is there any change, or are we in line with the same as last year?
Yeah, so largely Q2 is largely focused around your higher education. So with colleges opening up, we see that both higher education and the test prep segment should have a strong Q2, and Q3 is largely around promotion of your products to schools, and so that's, and of course settlement of your accounts with the channel partners. So we don't see a challenge in both of these, and while of course revenue numbers are not very high for both of these quarters, we do see the other metrics would largely be well in line.
Got it. Thank you, and wishing you best.
Thank you.
Thank you. Participants, you may press star and 1 to ask a question. Next question is from the line of Riya Mehta from Equitas Investments. Please go ahead.
Hello. Thank you for giving me the opportunity. My first question is in regards to how is the adoption by schools for the new NEP up to K2?
So last year it came around October, so since it had come in very late, the promotion season already starts around September to December. So while there was some traction, but of course it was not that substantial. Plus, what happens is schools would largely want to take the plunge together for most of the classes. So I would say last year impact was 20 to 25%. The major part of that impact will be seen in the current period. And of course, with the balanced classes coming in the current year, as and when the NCF is announced, we should see the large impact across the next 3 years.
But earlier we have said that every year we would see some 20 to 25% impact. So we've seen that kind of traction from the schools where they're requiring to change the syllabus.
We will be in a better situation to understand this probably more like October, November. I think the Q2 call, we will get a better sense because we would know if the NCF is out, the balance NCF is out by then. And since the promotion season would start around September, we would have a good feedback in terms of how schools are looking forward to the NCF. Our preliminary discussion that we've had along with the feedback of the schools based upon the last year's interaction with schools is that they are all looking forward to the changes in the NCF, and there is preparation in place. And there's a lot of training that is happening across from CBSE and for the schools in terms of adoption of the new education policy and the NCF. So the preparedness is there, and we will see the transition happening over the next 3 years.
Got it. My second question is in terms of price hikes. Since you've taken last year significant price hike, have you seen any impact in terms of volumes or any schools which have dropped? Because I heard from competition that they're seeing similar kind of trends with the price hike, that customers are not willing to take because of the current inflation scenario.
In terms of price hike, we didn't see much of an impact in some pockets, I would say, which is about 4, 5, 10%. There would be some impact, but there are some schools which are very price sensitive. But since the CBSE, ICSE segment is there, and most of the publishers did take a price hike varying between 15% to 30%. So we didn't see much of a challenge in terms of volumes there. And we, in fact, had higher volumes in the last year as compared to the previous year. But again, that could also be a function of schools reopening after COVID. So, to be honest, we got some feedback, but that was not a large feedback that price hike is impacting the volumes. So.
And in terms of this year's price hike, we're going to do a single-digit price hike. Are you foreseeing any pushback coming from schools or something where they would move to our competitors and leave us?
So it's a single-digit, around 6-7%. That is what we are looking at, and again, very selectively across products. That's the weighted average that we are seeing. But not really. We don't see an impact because in some years, of course, we did not increase prices also, but then that did not spur volumes to that extent. So in terms of our product, which goes, it's more of a adoption product which a school adopts and then the students have to buy the books. So we don't see much of an impact in terms of that kind of demand.
And in terms of, are we adding any new schools recently?
See, this is a year-round activity where we continue to engage schools through workshops, through various interactions with them throughout the year, and the adoptions, of course, do increase as and when the season comes. Of course, current period, of course, second quarter, there will not be any adoptions. The adoption will start from the end of the third quarter and then finally add up in the fourth quarter. So for the current period, of course, the last year we did have a lot of school adoptions.
Got it. And in terms of raw materials, since almost 60% of our import is already been contracted, so the lower prices, which is 8 to 10% in the lower paper prices, we wouldn't get any benefit in the current year. Is it fair to assume?
No, we will get benefit because, again, the contract has been at a lower... if they further reduce, of course, we may not, but currently as things stand, we don't see a substantial reduction in paper prices during the... If the reduction had to happen, it would have happened by July, August. Beyond this, the paper purchases begin for the publishing industry, and we would see paper prices only going up. That is what we understand. So,
here we will, to answer your question, we will get the positive impact of this lower price in this sale season itself.
So we would get some kind of positive impact in this season.
Yeah, obviously, no. Yeah, see, currently we have only 100 crores of inventory, and if you look at our guidance, it's at around 720 crores to 750 crores, right?
Yes.
So there is a huge gap. The paper which will be bought over the next 3, 4, 5 months will be used in the sales of the sales season, which is in Jan, Feb, March.
Okay. But these contracts typically work on the prices which have been decided as on today, right? Or as on when the contracts have been signed?
No, the prices are, so for the import, the prices are already fixed for the supplies up to December. And for the others, we continue to negotiate the price. And of course, we kept 60% fixed. 40% is variable. In case it goes down, it will definitely benefit us.
Okay. And my last question, are we seeing any returns from the Jan to March sale currently?
So we do get about, our average returns have been reducing in the last 2 years. We hit a peak of 25 to 26% in 2 years of COVID. Last year we were down to about 15.8. This year we are estimating around about 14.5%. So that we've been very careful in terms of the quality of sales that we are doing. Returns are coming in, but they are largely in line with our expectations.
So majority of the returns come in from August till October, let's say.
Okay. Right. Right. I think that's it from my side.
Thank you. Participants, you may press star and 1 to ask a question. Next question is from the line of Manan Paril from Merawat Capital. Please go ahead.
Thank you for the opportunity, sir, and congratulations for all-round very good performance. Sir, first question is regarding the gross margin. So when you say like you will take a price hike and the paper prices have reduced at least for the 60% of your inventory, so your gross margin should improve. So when your EBITDA margin guidance of 16 to 18%, does that bake in the gross margin improvement, or we can see further improvement if the gross margins are better?
So see, this year actually we have given a EBITDA margin guidance because in case the NCF comes through, there will be some extra spending in let's say marketing activities. So we are not trying to pin down a number for the gross margins here. And that's why we have, kind of given a guidance of the EBITDA range. Obviously, there can be upside, but these are a couple of moving variables. So we need to kind of see how it pans along.
Understood. Sir, the second question is on the NCF itself. So by what time does NCF needs to be announced for you to have the benefit in this year itself?
So the sooner it comes, the better for us and for the industry. But having said that, I would say a lot of the schools are already looking at a change in the product portfolio. So hypothetically, even if it doesn't come this year, there will be a lot of products going out in the market which will be aligned to the draft NCF and stuff. So I think a formal announcement may spur the demand, but even if it doesn't come in, it should not impact us too materially. Because again, a lot of schools are looking at changing the list of books that they do, and a lot of new products are coming out for us. Almost we are looking at about 500 plus SKUs across subjects. So that will definitely get us better traction.
Understood. So, sir, your guidance of 720 to 750 crores of sales, does that factor in NCF? And if NCF doesn't come, how does that pan out?
So 720 is the base, I think. Even if NCF does not come in, then 720 is definitely will be done. And if the NCF does come in, we can look at a higher number. I mean, it may go beyond 750 also.
And so you mentioned about adding new schools. So just wanted to understand like how competitive is the market and how difficult it is to add new schools. And when you add new schools, are they completely new schools opening, or schools are moving from the other vendors to you? So if you can explain the competitive scenario in that, really helpful.
So It is a competitive scenario. I think there are a large number of companies who provide quality content to schools. There's some international publishers and some good domestic players also there in the market. So competition is definitely there. We try to engage the schools more with multiple interactions, including we do a large number of workshops with them, helping their teachers teach better, subject-based workshops in math, science, Hindi, Divas, and a lot of other interactions that we do with them. So in terms of increase in number of schools, of course, we look at multiple things. One is when there is a new school which is not a user school, that comes on board, or if there is an existing school which is using probably one or two subjects, we can increase that to multiple subjects, or there may be some schools which will move to a complete book list, which is that they will adopt all the books from the company. Plus, of course, we do have curriculum products which is there from K to 8, where the school does take on the full curriculum from us only. So we have multiple product lines and which are very strong with schools, and that is what we are trying to expand. And so that promotion will happen this year.
And sir, again, sorry to harp on this, but as you mentioned, there is good and strong competition in the market, but they would also be taking up similar steps, right? So just wanted to understand what is our competitive advantage. Is there an unorganized market which you can take? So can you explain that a bit more?
Yeah, so there is an unorganized market which may not be able to ramp up to NCF so quickly, so that's one advantage. Second, I think in terms of financially, we are very strong over the last couple of years. We've built our own war chest to go out and, to be able to promote to schools freely rather than the kind of restrictions that we had a couple of years back. That plus we know what we want to do at this point of time. There's a lot of clarity in the kind of product portfolio that we have. We are well planned in advance in terms of products, in terms of promotions, in terms of engagement. So we are very well focused. There are some players who are having their own challenges in terms of funding, having their own challenge. Some international publishers who've sold out, which are having their own internal issues. So we have taken advantage of that in the previous year, and we'll continue to gain market share on account of that.
So Manan, just to add here, see, if I want to give you a flavor of the landscape, there will be thousands of publishers, okay, but in this year, when the NCF comes, only a handful will be willing to invest in creating the new kind of content which is there. Every publisher is not going to do it, right? So, I mean, as it is, the market, I mean, our competition becomes from thousands of publishers to a handful. So that is where, the differentiation comes through for the customer also to see. So the customer is also seeing which companies are kind of giving, information or workshops or trainings around what is going to come this year. So that, I think will be a big differentiator when it comes to choosing your content partner in the new NCF regime. So I think that's the way to kind of look at it in terms of competition.
That's very helpful, sir. And the last question is on the capital allocation side. So now that we are a net cash company, I understand that you have seasonality in terms of investments in working capital. Given the cash flows that you are generating, and you started with dividend policy also, so can we expect any inorganic route for your company apart from the small investments that you make? So do you look forward to inorganic investment in your own business?
Yeah, so we are looking at something right now also. We've taken approval from the board to look at a certain transaction. I cannot share details, but yes, we are looking at something which is not too significant, but again, we're looking at very strategic investments where we have gaps in our own portfolio which can build up, and we will continue to look at that. But we will do whatever we do with existing cash flows that come from within the system. Will not raise equity is any investments. So we are looking at one transaction, and once things are finalized, we will definitely announce it.
Thanks a lot, sir. That is all from my side. Your answers are very good. Thank you.
Thank you. Participants, you may press star and 1 to ask a question. Next question is from the line of Raj from Arjav Partners. Please go ahead.
Hello, am I audible?
Yeah.
Hello. Sir, I just skipped the part of the EBITDA front. How much of EBITDA we have guided for FY24?
It's a band of 16 to 18%.
16 to 18% of EBITDA, and on the sales of 720 to 750 crores. Am I right?
Yes, that's correct.
And also, how many SKUs are we planning to launch?
500 plus.
Around 500 plus.
Around 500 plus. All right. Okay. Thank you. That's it. All the best.
Thank you. Participants, you may press star and 1 to ask a question. Next question is from the line of Nitendra Mawat from Aurum Capital. Please go ahead.
Yeah, thank you for the opportunity again. I was not very clear about, you mentioned about the acquisition possibilities, right? So what kind of size we are looking for, if it is acquisition indeed?
Nitin, this is a very small one. It's not a very large one that we are looking at. It's a very niche kind of this thing. I can't share more details because, again, we are in NDA right now and we haven't signed the term sheet yet. But it's not a very large allocation. We've taken a board of approval of about up to 20 crores. So it's well within our cash.
So this is also documented in the exchange release, Nitin. We have taken a board approval of up to 20 crores.
Got it. Thanks so much.
Thank you. Participants, you may press star and 1 to ask a question. Next question is from the line of Riya Mehta from Equirus Investments. Please go ahead. Riya, sorry to interrupt you, but you're not audible.
Hello.
Yes.
Am I audible?
Yeah.
So in terms of gross margin, are the current gross margin on June quarter sustainable for the rest of the year?
First quarter slightly normally higher by a couple of percentage bits, but as you see, second quarter, third quarter, the volumes are lower. So it will come down, but overall on the full year level...
So we have to see. I mean, it depends on how the paper prices move here.
Yeah, but since our 60% prices have been contracted, so I think we would have a fair sense of the...
But still, see, the thing is that with regards to paper prices, very fluid. So 60% is contracted, that's for sure. I think that's why we have tried to give a EBITDA margin band and we are working with that.
Just to top up with that, Riya, I mean, again, the quarter-to-quarter EBITDA guidance doesn't really work because the product portfolio across the quarters changes. Q1 is largely around your classes 9 to 12 books which are slightly higher priced and, are more reference books. So there we would have a slightly higher margin as compared to the quarter 2, quarter 3 where higher education comes in where the margins may be slightly lower. So the product portfolio across quarters which goes to the market, there might be a 4-5% gap here and there. But overall for the full year, I think we should be slightly higher than what we were last year. And but I mean, looking at it on quarter-to-quarter basis is a bit difficult to answer.
And in terms of import and domestic, what would be our breakup for paper prices?
I said that before, 60 and 40. 60% imported and 40% domestic.
Okay. And the domestic is, the contract is for what period?
The domestic we haven't contracted. We are just giving orders on order-to-order basis. We are not contracting yet.
Okay. Thank you.
Thank you.
Thank you. Next question is from the line of Puneet Mittal from Global Core Capital. Please go ahead.
Hi, thanks for the opportunity. I just had one question regarding, again, on the capital allocation. I reckon with the numbers that you've suggested, you are looking at more than 100 crore plus of free cash flow. Now, unfortunately, the reinvestment opportunities that you have is very low, as you had mentioned. And our return on capital employed and our return on equity is low because naturally we have large capital employed and we can't change the numerator much because the growth does not seem to be very high and the investment opportunity doesn't seem to be very high. So the only way for you to improve the ROCE and ROE is to reduce the denominator through share buyback or return of capital. So what is your thought around that to improve the ROCE and ROE of the company? Thank you.
Yeah, so thank you. I think, thank you, Puneet. Very, very, very relevant question, and that is something that we have been also thinking about. But you look at last 2-3 years, especially the 2 years of COVID, we've had major issues in terms of cash flow. So we are a bit conservative in terms of our capital allocation. We would like to have a minimum war chest available for these kind of uncertain circumstances that have happened. However, having said that, we have restarted the dividend payment, which is the highest that we are paying in the last. We're paying 3 rupees right now, and your suggestion of buyback is well taken. It's something that we would definitely consider for next year once we are through with this current year. And since if we don't have any large buyback opportunities available to us, large acquisition opportunities available, we would definitely like to look at that as a definite option for the next financial year. We'd like to give it 1 more year for that, but that is definitely on the table for discussion.
Great. Thank you so much and all the very best. Thank you.
Thank you. Participants, you may press star and 1 to ask a question. Next question is from the line of Purushottam, a retail investor. Please go ahead.
Hi, thanks for the opportunity. I wanted to ask for some of the investments which we have done in organizations like SmartEVT and all, where I think we invested since 2015 and the organization seems to be doing well because I use their products. So I wanted to ask, do we have plans to increase our stake out there? As of now, I understand it's around 60%. So some of these organizations which are doing well, do we intend to increase our stake and maybe take forward some of the other engagements also, or we'll stick to it as an investment only?
So in terms of SmartEVT, we continue to be a large enough investor, and considering that they're not looking to raise further capital at the moment, so I don't see a way of increasing our own stakes except for doing a secondary buyout from some existing investors. But since they already have they already have marquee investors on board. A couple of them are pretty well-known names apart from us. So I don't see our percentage, and it's large enough. In a couple of years, we probably will be looking at exiting because strategically we are no longer involved in the day-to-day operations and management of that entity. We continue to support them wherever possible, but we would be looking at an exit maybe 2-3 years down, maybe 1 or 2 years down the line.
Okay. Thank you. That's it from my side.
Thank you. Participants, you may press star and 1 to ask a question. Ladies and gentlemen, you may press star and 1 to ask a question. Next question is from the line of Jinesh Joshi from Prabhudas Lilladher. Please go ahead.
Yeah. So my question is surrounding the gross margins. I think in the initial remarks you mentioned that our gross margin was higher at 69% due to better planning and low wastage. So if you can just explain that a bit. And secondly, if I look at our finished goods inventory, it is at about 100 odd crores. And given the fact that 2Q is seasonally not very high in terms of top line and all, and given we have a decent quantum of finished goods inventory, do you think that the sustainability in gross margin in 2Q and 3Q could be surrounding the level which we reported currently, given the fact that there will be minimal impact of price hike and the finished good inventory is already there with us?
Yes, thank you, Dinesh. Just in terms of a gross margin, the impact has been because of better production planning during the first quarter versus last year, because last year the schools were reopening. There were a lot of follow-up orders where the print runs were very, very small. So, and plus there were multiple supplies going in terms of even our freight costs were higher during that period. So better planning has resulted in better gross margins for the first quarter, and of course the number of supplies that have gone are also lower in terms of the quantum of supplies, number of shipments. So that's definitely helped us. Better planning is the only reason why our gross margins are better in the first quarter. In terms of finished good inventory, when we talk about 100 crores of finished good inventory that you're talking about, please be aware that out of this 100 crores, about 30 crores is something that is already lying with my channel partners. This is just on account of the provision for sales return. 30 crores is accounted for as a stock lying in my books, but it's actually the amount that will get returned to me during the next 3-4 months. That's just a provision. So actual inventory with me around would be about 70 odd crores. So just want to make that differentiation. It's around 70. As and when that comes back to me, of course, it will be part of my inventory. And after that, of course, how it will help in terms of gross margins, of course, whenever we sell in the new season, on the existing inventory also, the price of the product gets changed and then it goes and is sold. So, of course, since we are doing a single catalog, so of course we can't sell books in two different prices. So the existing inventory also gets repriced.
Got that. Sir, my second question is with respect to the SKU count. I think you mentioned that we are planning to launch about 500 new SKUs. So can you explain which all product categories are you referring to, and is this completely new and different where we were not present earlier, or is this just basically a flip to the existing product with a new cover page and we say that, okay, this complies with NEP 2020. So how is it? I mean, completely novel or a flip, so to say?
So I would say it's a mix of all three. I would say out of the 300, about 100 to 150 will be new products, both in the school and higher education segment. We continue to bring out new products every year. Last year we brought out series in artificial intelligence for schools, which have done decently well last year. That was a new product category completely. This year in terms of higher education, we're doing a lot of products with YouTubers in terms of the government exam market. So there we're also getting good traction. Plus, of course, the NEP in higher education has come out in a lot of states. So a lot of regional products are coming out in that segment. Second category, of course, is, upgrading the existing bestsellers that are there in the system. So there, those SKUs also come around, of course, and then there are translations that are happening in the test prep segment, which are also is existing content which is getting translated into new languages. So I would say it's a mix of 50% is the upgradation of the existing content, 25% is completely new content, and 25% is I would say substantially revised content. I mean, that's just a broad one. It may vary about 5-10% here and there.
Got that. Just one last question. On an average, annually, how much tons of paper will we be consuming in FY24? Because you have mentioned that we have contracted 60% of our supplies via import. If you can just give me a rough indication, then I can do the math from my side.
So it's about 18,000 to 20,000 tons.
Sure, sir. Thank you so much. That's it from my side.
Yeah.
Thank you. Participants, you may press star and 1 to ask a question. Ladies and gentlemen, you may press star and 1 to ask the question. As there are no further questions, I will now hand the conference over to the management for closing comments.
So thank you everyone for taking out time and joining us for this quarter one conference call. And we look forward to another decent year ahead and focusing completely on good working capital management, improving cash flows, and bringing out content for schools and colleges during the current year. And of course, the announcement of the NCF, which is a major thing that we are waiting for. So thank you and look forward for the next quarter. Thank you so much.
Thank you very much. On behalf of Prabhudas Lilladher